Hey everyone, welcome back for another dividend investing video. I have a list of high yield dividend stocks I am putting up for consideration to add to our dividend growth income portfolio. In a video reviewing the portfolio for October 2022, I mentioned that I wanted to add a couple more income-oriented higher yield stocks to this mix. And today I'm going to show you the list of stocks I'm considering. I'm welcoming your input. I'm Nick and this is the Dividend Growth Income channel. Thank you for joining us. I am not a financial advisor, just a guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could do me a favor, please smash the like button for me and subscribe to keep up with future videos. This helps us out more than you could imagine in bringing you quality dividend investing content. At the moment, the yield of our dividend growth income portfolio is at 2.73%, and we're about 2 months into having this account. Right now, the composition is about 25% in index funds and ETFs and 75% in individual dividend growth stock. Now, I heavily prefer dividend growth stocks over high yield dividends at this point. I'm not anywhere near retired. I don't need the income. So I'm looking for dividend growth. Now, I'm not chasing yield in this account, but a couple months in, I do think there would be some benefit to upping this yield a little bit. And to illustrate, I want to take a look at SCHD. And this ETF by Charles Schwab is nearly the unanimous favorite amongst dividend investing circles, and it's easy to see why. I would argue the biggest reason for this is because it hits that perfect mix of dividend growth plus dividend income. And let's take a look at its top holdings. Amgen, Home Depot, Broadcom, Texas Instruments, Pepsi, but also has companies like Altria, IBM, and Verizon. And these are companies that pay a higher dividend yield, and this combination together gives investors that yield above 3% with double-digit growth every year. And I think our portfolio could use a couple companies like this to help bring it above that 3% mark. And again, we never want to chase yield. That is a dangerous game. When looking for high dividend yield, we want to be sure that the dividend is sustainable. We don't expect much in the way of dividend growth. And if a company is taking on debt to finance its dividend, that is not sustainable. If a company is paying out more than it brings in for free cash flow, that is not sustainable. Dividend cuts are possible, and when you start getting into these higher yield stocks, they become more likely. And in fact, a couple of these candidates have cut their dividends in the past for various reasons. Now, the list I'm picking from, these are all imperfect companies that meet the following criteria: a yield over 4%, a PE that is below its 5-year average, a Simply Safe dividend safety score of 60 or better, which is safe, and I also don't want to own these in my other accounts. For example, I own some Verizon stock I mentioned in another video in another account I have. So I'm not looking to add more Verizon, which would have otherwise been a candidate in this video. And so I have 10 stocks here, and I'm not going to go into great detail on any of them just to keep this brief. I'm going to simply go over some basic fundamentals and list out the pros and cons of investing in them from my perspective. Please leave a comment with your top 3 out of this group. I want you guys to help me out here. And these aren't ranked in any particular order. So the first company I'm considering is AT&T, ticker T. AT&T is a telecommunications holding company. It's the largest telecom company by revenue and the third largest provider of mobile telephone services in the United States, and can trace its origins back to 1885 and Alexander Graham Bell. Now today, AT&T is yielding 5.83%, a little bit lower than its 5-year average, but we did just sustain a dividend cut. Performance over the last year is practically flat. This is a stock I previously owned but sold when they announced the spinoff of the media business and subsequent dividend cut. It was a good decision at the time to sell. I took a slight realized L, but spared myself a much larger unrealized loss and was able to reallocate that capital to a better place. But now that the spinoff is completed and the dust has somewhat settled, I think the company deserves another look, even though I swore I was done with them when I sold them a while back. As things stand now, the payout ratio for the dividend is low at 47%, and while their debt remains a concern, things seem to be trending better, making this a possible time to consider re-entering the company. Simply Safe Dividends provides a safety score of 70. I like that this increases exposure to the communications sector, one we're lacking exposure with only Comcast in the mix at this time. I also like that it would beef up our February, May, August, November dividends, which is also currently lacking, although this is more of a bonus nice to have and should not really be used as a deciding factor for an investment. So this is the first company we're considering. The second company on the list is Philip Morris International, ticker PM. Philip Morris is an American multinational tobacco company. It was spun off of Altria back in 2008, with both companies supplying customers with the popular Marlboro brand, Altria in the United States, and Philip Morris International everywhere else. So here you are getting exposure to an American company, but its business is entirely international. I do own shares of Altria, but do not at this time have any stock in Philip Morris. Shares of Philip Morris are yielding 5.38%, pretty close to the 5-year average. Price performance over the last year is mostly flat. Payout ratio is quite high in terms of earnings. They're paying 93% of forward earnings as dividends, but this is not unusual for a tobacco company, so I'm not concerned with this. Simply Safe Dividends provides a safety score of 64. There are long-term concerns with this industry and how it will evolve. Some investors avoid it entirely for various reasons, but I'm adding it to the list of candidates. I like the international exposure this gives us. It's important to understand the markets Philip Morris is in and how tobacco use is evolving in these markets, as well as how smoothly Philip Morris can transition to smoke-free products that deliver nicotine through various delivery systems. The third stock on the list is Walgreens Boots Alliance, ticker WBA. Walgreens is the second largest pharmacy store chain in the United States behind CVS Health. They are part of the consumer staples sector in the drug retail industry. This is a value stock down 44% over the last 5 years. So the question is, can they turn things around, or is this a business in decline? Walgreens can be gotten at a 4.83% yield. This is 34% above its 5-year average of 3.59%, and at a very low 8.8 PE. The dividend is well covered at 43% of forward earnings. It's at 76% of free cash flow, but this looks like an outlier. It would be worth digging into and finding out what's going on. A lot of retail is struggling at the moment, so I'm going to do some further due diligence on that. Simply Safe Dividends gives us a safety score of 79. They have a stellar track record of dividend payments, 47 years of dividend growth, and 91 years without reducing the dividend. Until recently, I would have considered this a dividend growth stock, but now the increases are nominal. One downside to this company is they are exposed to a higher than average amount of legal risk and face litigation often due to the nature of the products they sell. I don't see Walgreens going away anytime soon. Their position in the industry is firmly entrenched. In my area, there is a Walgreens on nearly every block, and there is one within 5 minutes of just about anywhere in the area. Long-term concerns remain with how this industry evolves, especially with Amazon, heavily considering adding some Walgreens to our portfolio. Stock number 4 is Intel Corporation, ticker INTC. It's a chip maker in the information technology sector, and there's lots I could say about this one. It's been one of the more controversial stocks in the dividend communities for 2022, second to perhaps only 3M. Investors are down 40% just in the last year, and with that drop, Intel is now available at a 4.9% yield. And to get an idea of how fast things have declined for this company over the last few years, let's just look at the safety rating history from Simply Safe Dividends. 2 years ago, this was a 96, and last month, this was just downgraded from 80 to 70. They still see it as safe, but the forward payout ratio is telling me to be cautious with this one. I'm probably not going to go with this one, as I think Intel might actually do better to cut their dividend for a couple years while they attempt to right the ship. I'm probably going to make a video to go further into this one in the near future and my thoughts on Intel. It's probably a solid long-term recovery play, and I'm certainly rooting for that. But I would rather get into it when I see some signs of turnaround in their overall numbers and just look at this decline in earnings per share. But we are going to keep this in consideration. So the fifth stock under consideration is VF Corporation, ticker VFC. This is an American apparel and footwear company trading in the consumer discretionary sector, best known for brands like Vans, Timberland, the North Face, and they also have a hold on a large sector of the U.S. backpack market, 55%. In fact, VFC has had a negative return over the last 10 years. It's been a major loser with all due respect, but could this be a recovery play? It's down big time, 57% in the last year, and trading at a 13 PE, which is far below its 5-year average of 23. It has the best Simply Safe dividend score out of the group so far at 80, and this is the best group out of this entire 10 that I'm sharing. We can get VFC at a 6.17% yield, and this is 150% higher than its 5-year average of 2.47. Now, 50 years of consecutive growing dividend payments, making them a dividend king. Now, softening sales and inflation is hurting this company, no doubt. Some of these brands, though, have loyal customer bases, and in economic recovery, it's easy to see this one turning around. So it's on our list for consideration. The sixth stock on the list is Leggett & Platt, ticker LEG. Leggett & Platt manufactures products and components that are used in our houses and automobiles. They've been in business since 1883, where they developed a new, at the time, type of bed spring consisting of a single cone spring wire coil. LEG is down 18% over the last year. Not as bad of a beating as some of the other companies we're looking at. With Leggett & Platt, we are getting a 5% yield that looks reasonably safe. Coverage by free cash flow is concerning, but it looks like an outlier, worth keeping an eye on. Simply Safe Dividends gives us a safety score of 70, and a wonderful track record of 50 years of dividend raises, making this another dividend king, and one of the stronger on this list in terms of dividend growth. This is one of those under-the-radar companies that has products that are in all of our homes, and the demand for these isn't going to just go away. And for that reason, we have to consider adding some LEG to our Dividend Growth Income Portfolio. Moving along, the seventh in the list is Kinder Morgan, ticker KMI. Kinder Morgan is a midstream energy infrastructure company controlling approximately 83,000 miles of oil and gas pipelines. KMI is the largest natural gas pipeline operator in the United States. As with most energy stocks, Kinder Morgan is up over the last year, and they're up about 14%. Currently, they're yielding about 6%, and this is in line with its typical yield. For a company like this, we looked at price to distributable cash flow, which is similar to free cash flow for pipeline companies. And the dividend makes up 52% of DCF, and the preference is to see this below 70, so that looks great. The negative here is the track record. KMI cut its dividend back in 2016 and still hasn't recovered. But things have stabilized since, and we have 4 years of consecutive dividend growth. But we have to be cautious. This is a cyclical business. Simply Safe Dividends gives us a safety score of 61. This one is a very likely candidate to be added because at the moment the only company in our portfolio in the energy sector is CVX Chevron, and I think this could make a decent addition to increase the income and diversification of the portfolio. Although out of all the options, this one sort of has that feeling of chasing yield. All right, the eighth stock on the list is Cracker Barrel Old Country Store, ticker CBRL. They are a Southern Country themed restaurant and gift shops. These can be found all over the major highways in the United States. If we were to add this one, it would be the first restaurant added to the mix in our portfolio. Places like this got hammered during the COVID pandemic and are now struggling with things like supply chain, rising labor costs, and rising food costs. This is the company due for recovery when the economy turns around and there are more folks on the highways and the economic conditions are more favorable. In the last year, the company's stock is down about 18% and can be gotten at a 4.5% yield. Like many restaurants, they were forced to cut their dividend in 2020 during the pandemic as they were largely a dine-in style restaurant and were forced to close their doors for a few months. Even now, that payout ratio is on the high side of 80% of earnings, and Simply Safe Dividends gives the safety score of 70. Now here's what I find most appealing about this company. Before 2020 and all that craziness that followed, these guys were paying massive dividends. In fact, from 2015 to 2019, there was an annual special dividend, and these would range from $3 to $3.75, in addition to their already generous quarterly dividend. Basically, when things are right for this company, their history shows they will reward dividend-minded investors, and that's why I'm throwing it in the mix for consideration for the portfolio. The ninth company in consideration is Main Street Capital Corporation, ticker MAIN. Main is a business development company, or BDC. We don't currently hold anything like this in our portfolio, and I'm not crazy about companies like this generally, but this is one of the best choices in the sector for income-minded investors, and they pay a pretty steady dividend. The stock is down about 18% over the last year and can be bought for a 7.14% yield at the time of publishing. Normally it trades around a 6% yield. And this would be adding another monthly payer to the mix. We already have Agri Realty, and they would be another one that also pays special dividends. In fact, they have paid out special dividends every quarter for the last year, usually around 10 cents per share. On the downside, the dividends here are non-qualified, but for the time being, our account is not big enough to worry about this too much, and 7% is pretty damn good, and the track record there for 11 years of dividend growth is looking pretty nice. The dividend looks well covered, and Simply Safe Dividends gives us a safety score of 62, so this is one we could potentially add to the portfolio. All right, and last on the list is the JP Morgan Equity Premium Income ETF, ticker JEPI. The last equity under consideration is not a stock, it's an ETF. It's a covered call ETF specifically, and I'm generally not a fan of this for my own investing purposes. Basically what happens here is premium is paid out in monthly distributions, and since they're selling covered calls on the holdings, there's not much upsides to these things. However, all the downside risk is still there, and I don't think it makes a whole lot of sense to hold these in a bear market. For my own purposes, but it's worth throwing into the mix of consideration with that 10% yield, and they do distributions monthly. There are several of these covered call ETFs, and if I were to invest in one, it would be JEPI. But like I said, generally not a fan of these at this stage in my own investing career, but there is an outside chance. So here are the list of companies I am considering, all of them imperfect and have their issues, but all viable candidates to add that little boost of income to our portfolio. I'm going to be adding $200 to my portfolio this Wednesday, and we'll probably pick 4 of these and put $50 into each one, adding them into our dollar cost averaging. I would love to see which one of these you guys own or think would make the best additions to the mix here. Any feedback is great. So please leave a comment. And once I add these, I'll be done adding any more new companies to this portfolio for at least the next year or two. I think we have a good number of companies here now going forward. So still the majority of the funds in this portfolio will be going into the dividend growth oriented stocks, and the 3 largest positions will always be these 3 ETFs, which are SCHD, VYM, and VOO. The idea is adding a few more of these income oriented stocks, we can get the overall yield of this fund over 3%, and that's really what we're looking at here. I'll make another video letting you guys know the final 4 I pick. It'll probably come out, sometime in the next week here. I hope to have you all have a wonderful Thanksgiving. And be sure to check me out on Twitter at Div Growth Income. We just passed 5,000 followers over there, and assuming it's still up when you see this. Until next time, keep investing.